I am Ira, and with me are more, Diane, Janelle, and Red, and we are Excelsior, giving you our investment recommendation for a stable company amidst an evolving environment. Meralco. With forecasted growth in energy demand by the DOE, it is undoubtedly another fruitful year for Meralco. However, despite this affirmative anticipation on one of its major drivers, the team recommends a hold rating. As of November 29, 2013, they were trading at 278 pesos, and we recommend and estimate a target price of 281.31 pesos, an upside potential of only 1.19%. But before we walk you through the basis of our recommendation, let us first have a glimpse of Meralco. Meralco is the largest power distributor in the Philippines that currently serves 5.2 million consumers, accounting for 75% of Luzon's and 55% of the Philippines' energy sales. Distribution, as the company's main line of business, captures about 96.64% of the total company revenue. With the introduction of the retail electricity supply, the company expects this to enhance the revenue stream by about 2.63%. Moreover, venturing into power generation will give Meralco a more efficient and stable energy source. So how did this good profile lead to a hold? Ladies and gentlemen, these are the three main reasons. First, Meralco remains vibrant amidst an evolving environment. Its good fundamentals prop up the company against its uncontrollable costs. Second, financial drivers are expected to gear down despite its phenomenal growth in recent years. Lower tariff and higher power costs drag a growth that would otherwise make the stock attractive. And third, a DCF valuation revealed a hold rating. With a positive but stable free cash flow, our valuation confirms and reveals an upside of only 1.19%.
But before we go to the financials, let us first take an overlook of the macroeconomic story. The Philippines is the fastest growing country in the Southeast Asian region with almost 7% growth. Also, with a stable inflation rate, this is expected to continue. Another thing is that the ASEAN integration is expected to be the catalyst toward achieving inclusive growth. And this positive outlook of the Philippine economy opens up a lot of opportunities for a diversified power industry. And Meralco is expected to take advantage of it. The main advantage of Meralco is that it has a virtual monopoly in its franchise area. With a total land of 9,337 square kilometers, producing 50% of the Philippine GDP and 60% of the manufacturing sector. With this, Meralco has become the largest power distributor in the whole Philippines. Another strength of Meralco is that it has a diverse category of its consumers. It has the 62% of the testable consumers leading the retail electricity supply market. Moreover, the company is also exploring possibilities in the power generation sector. With the anticipated 3,000 megawatts of total capacity, Meralco is expected to be the second largest power producer by 2017. Overseas, Meralco is also investing in Nigeria and in Singapore, but these are currently small portions of their revenue streams. With the positive economic outlook, good business fundamentals, and advantageous strategies, why is Meralco still slightly overvalued stock?
And to answer that, let's take a look at Meralco's financials. With the unique revenue structure, power cost is the most critical item to Meralco's operations, affecting both top and bottom line figures. We anticipate this cost to steadily grow by 2% in the short run as the company manages to secure purchase power agreements until 2025. However, by 2015 to 2016, as energy supply thins out, Meralco's exposure to Western would be greater, thus driving the costs to rise as high as 4%. Moving on, revenues of the company is expected to increase by an average of 6.18% for the next 5 years, slower compared to its historical revenue growth. Despite increased power demand, margins through rest and ventures for expansion
revenue would not spike as projected due to the following reasons. First of all, we expect that a lower tariff would be implemented by 4th regulatory period. With WACC at 11%, tariff is estimated to be set at 1.25 late 2015. The full effect of this application would be observed by 2016, the lowest revenue growth point. Secondly, we expect that revenue contribution from the power generation segment would be only realized in 2017. Given this, margins of the company would move positively until 2014. By 2016, a fall of 12% is expected also because of higher power costs. Further, EBITDA will be in the same directions as margin, given that operating expense of the company would be mainly driven by the country's inflation rate. This affirms our hold rating.
Applying these financials in the sum of the parts multi-stage free cash flow to the FIR model, we have arrived with a target price of 281.31 pesos. Using this method, we have captured the separate growth opportunities of each segment. Let us now proceed to the three main components of the FCFF model. First, a 10-year projected cash flow is applied to consider the long-term impact of Morocco's power generation. This ample cash flow is driven by revenue growth as a result of RES and power generation expansion and continuing increase in electricity demand. Conversely, a lower net profit margin results from an increase in generation rates. Moreover, Morocco's otherwise high cash flow was heavily dragged down by its capital expenditures, most of which is attributed to its power plant constructions. Second, a WACC is computed from a 3.5% cost of debt and a 15.57% cost of equity. Using the appropriate rates for each rate, we have arrived with a 12.87% WACC. And last but not the least, the terminal value, which is the main component of the DCF model, is driven by a terminal growth of 8.055%. Slightly higher than that of the projected growth of the Philippine economy, we justify this higher rate with synergy. The vertical and horizontal integration of Morocco's different segments will enhance Morocco's long-term profitability by improving its cost structure. Utilizing these components by applying sound and empirical assumptions, we have arrived at the breakdown of Morocco's share price. The bulk of the aggregate price is due to the power distribution, which means that power distribution still holds to be Morocco's leading segment, while RES and power generation could be one of the drivers that could boost Morocco's long-term profitability. This segment prices then translates to Morocco's target price of 281.31 pesos. This presents a mere 1.19% upside and strongly supports our hold rating.
Having considered Morocco's upside potential, we also tried to consider the downside by looking at its risks. Our team expects three main risks to be experienced by Morocco this year. The first one is natural hazards risk, brought by the effects of natural calamities that can result to operational and supply chain problems, resulting to a possible negative effect in the company's future earnings potential. The second one is regulatory risk, which is due to the possible decisions of the government that can alter the price model of Morocco and can decrease the company's efficiency in bill collection. Another risk Morocco may experience this year is expansion risk, brought by the company's venturing in the local and international market. However, executing proper logistics and knowing the market may be difficult due to first, unfamiliarity, and second, presence of competitors. Aside from this risk, lawsuits and negative publicity can also affect the company's reputation. However, up to this date, Morocco's history proves that it can manage to remain competitive. This simply proves that Morocco is a strong company. However, our team believes that as of this moment, it is not yet a timely investment, and we recommend a hold. And it is mainly because of three reasons. First, Morocco is a vibrant company amidst an evolving environment. Second, it has low growth despite phenomenal performance in the recent years. And third, it has a confirmative valuation. Our valuation confirms the hold rating. Thus, With a given price of 281.31 pesos, a 1.19% upside from the market price, our team strongly recommends a hold rating. Thank you, and now our team is open for your questions.
Thank you, Excelsior, your judges.